Okay, so for my investments, the exam 3, the first step I done was I took the Nike, Southwest, and Amazon last 10 years of adjusted closing prices, downloaded them from Yahoo Finance. The next step was to generate the returns for each month over month, and I took that by calculating the previous, dividing the previous month by that month, and then subtracting that from 1. And that gave me all the returns for each of the stocks month over month. Then I ran the average monthly return for every stock. For Nike, it was 1.12%, Southwest was 0.7%, and Amazon was 1.98%. I then annualized it by multiplying those numbers by 12. Nike's was 13.43, Southwest was 8.39, Amazon was 23.76. And then after I done that, I took the covariances for each of the returns, and that generated my variance and volatility calculations. The next step I done was I generated 1,000 random portfolios by doing a rand between function of 1 in 10,000, and then I divided the sum of those by the cell, and it gave me 1,000 random percentages that added up to 100%. And like I mentioned earlier, my volatility and returns that I got from my statistical analysis my portfolio variances were equal to the sum of the weighted variance covariance matrix, and my portfolio volatility was the square root of the portfolio variances. It was basically just a sum product function that got me to that point by taking the sum product of the 9 values that I had. The next step was I generated a scatter chart from the 1,000 random portfolios. It looked like this. And basically all that is all the different weighted of the stocks. It's just generated just a bunch of different points, and you can kind of see the curve that it shapes from that. The next step that I used was I done the efficient frontier points and got a line from that, got a rough line. I done that by using Solver. I done a targeted return of each one that minimized the risk and changed the weights for each of the ones. I couldn't get a 24% return. The solver couldn't generate that. That was too much by minimizing the volatility. But I did get a 23.5% targeted return. That was the highest return I got. And then I just went down by 0.5 percentage point each time. And I listed 17 points on the efficient frontier chart. You can see here the orange dots are the efficient frontier. And basically all that is that's the most efficient weights for each of the ones. And obviously the ones on the top are more beneficial than the ones on the bottom, because the ones on the bottom of the efficient frontier have more volatility for less return. So we didn't want that. And then I took the betas of 10 stocks on Yahoo Finance and explained what the beta meant. And really all the beta means is that if your beta is above 1, then it moves quicker than the rest of the market comparatively, and if it's below 1, then you grow at a faster rate and lose, or you grow at a less rate and lose at a lesser rate than the average stock. I then done some I looked up the capital allocation line and the risk-free rate, and my market risk premium is equal to my return minus my risk-free rate. And really all the capital allocation line is that you're taking these risky assets, the stocks that we generated, and you're adding in a few risk-free assets, and obviously is at 2%. Some examples of a risk-free asset would be a government bond or something that it's not risk-free, but it's lesser risk than others. And then the Sharpe ratio, all that is the slope of the capital allocation line. And that is all I have.